Hi everyone, this is Umar. There have been many requests on how to select strikes on monthly options or weekly option. How do we select the best strike for a maximum probability of trades expiring worthless and so on, right? So we will see in this video how to select high probability trades using option Greeks. Before going into the subject, make sure you watch the video till the end, and I promise you this will change the way you trade options. And this calculation is very useful for trading strangles or naked calls or puts or even iron condor. You will not understand now, but as and when I explain, you will understand the concept fully. And this is how we trade or select strikes when it comes to strangles or naked calls or put. And of course, we have a strong disclaimer: trade with your own risk and responsibility, and consult your financial advisor before trading in options. Okay, now you have to understand two concepts here. One is standard deviation and second one is option Greeks. So what is standard deviation? In simple terms, standard deviation gives you the market's expectation of how much the stock can move. There are one standard deviation, two standard deviation, and so on. There is 60% probability the stock can stay between plus 1 standard deviation and minus 1 standard deviation on expiry day, and there are 90% probability that the stock can stay between plus 2 standard deviation and minus 2 standard deviation on expiry day. Now, we don't need to calculate the standard deviation of Nifty. I will tell you where you can find it. And if you want to know more about standard deviation, I will leave a link in the description below, and you don't have to give more importance to standard deviation, and you will understand in the later part of this video. The second thing is option Greek, and if you are an option trader, you should be knowing about delta, theta, gamma, vega. And if you don't know, I will leave a link in the description below. You can go and learn what is option Greeks. And in option Greeks, you must know what is delta. In simple terms, the probability of option going in the money is delta. If you see at the money call option strike, it will be having a delta of 0.5, and out of the money call option will be having a delta of 0.2 or 0.3. And if you see a deep in the money, it will be having a delta of 0.7 or even 1. As and when the out of the money strike nears at the money, the delta will increase, and always call option will be having a positive delta and put options will be having a negative delta. And when you sell a call option, it will be negative delta, and when you sell a put option, it will be a positive delta. Let me say it again. Call options have a positive delta, and when you sell the call option, it becomes a negative delta. Put options have negative delta, and when you sell the put option, it becomes positive delta. So you have to remember this. Now I hope you understand what is delta. Remember, the standard deviation and delta, these are the two things you have to remember before selecting options. And I am talking about strangles, put credit spread, or call credit spread, or even iron condor. Now let's see an example. Okay, now actually I am in sensible, right? Now what we will do is we will go to an option chain. Yeah. Okay, this is Nifty option chain, and option chain for 20th May expiry. Nifty is at around 14,677. Okay, let's select this 27th expiry. And if you see here in option chain, this is in sensible. Maybe you cannot find it in NSE option chain. There is call delta here and there is put delta here, right? When suppose say you are planning to take a strangle and you think market is range bound or market is in a tight range, what we will do is you have to see the delta, call delta. right? See, I am selecting a delta of 0.15. That means there is 15% probability that this strike is going to end in the money. I am selecting a delta of 0.15 and there is probability that this delta will close in the money. There is only 15% probability that this delta is going to be in the money, right? Now that is one naked call, right? I have sold 15,200. Now on the downside, go and see where is delta. Put delta of 0.5, yeah, that is 14,100. Select, yeah. Now if you analyze this trade will have a high probability. This trade is having almost a probability of 75% being in profit. Yeah, and if you see the margin requirements, I think it's 1.3 lakhs and 1.3 lakhs. Maximum profit is 6,131. And if you come down, you can see the standard deviation here. One standard deviation is around 244 point, which means it can move maybe 250 points up or down before expiry. That is what it is saying, standard deviation. So downside is 433 and upside is 922, and two standard deviation is 14,188 and 15,167. And always make sure you go for two standard deviation. And if we see our strike break even point, it is 14,018 and 15,281. Above and below the two standard deviation, and this standard deviation is available in Sensible. If you are having a Zerodha account, you can subscribe to this thing also, Sensible, and you will get this standard deviation here. And if you select a call also, or if you select a credit spread also, make sure, let's say you sell a credit spread, okay, put credit spread, sell a put which is having a negative delta like 0.5, like what I showed you, and buy maybe 100 strike or 200 strike below what you have sold. Same thing you can do it on the call side also. So this way you will have a 70% probability of this trade winning. So this way you will be having a 70% probability of the trade expiring out of the money, and you can keep the whole premium. See, if you see this trade, let me show you. If you see this trade, there is unlimited profit loss. I am not denying that. Whenever it is going to touch the break even point, you are going to make some adjustment, or you are going to exit the trade, or you will do some one thing or other, right? But that is not the point here. You are risking more, and your profit is going to be only 6,000. But as continuously you do this trade, you are going to be in profit. When you do it consistently, on a consistent basis, you are going to be in profit. One or two trade may go loss, I am not denying that, but when you do it consistently, you are going to be in profit. Let's say you do an iron condor with this concept, right? You go and sell a call with 15 delta, and you go and sell a put with 15 delta, and you buy calls after 100 strikes, right? And if you do this consistently for a period of over 6 months or 1 year, you are going to be in profit. And believe me, if you want, you can go to option Obstra, and you imply this technique, and you check from January 2020 to till don't check from, you can check. You check from January 2020 till December 2020, or even You can check from April 2020 or March 2020 till this month 2020. And if you check iron condor for the last 1 year, you will be in profit. That is why this concept, I am telling you this concept. So this is how we use this is how we select strike to trade strangles or iron condor. You can also use the same concept, and if you want, you can do more research about this. This is not big calculation or big stuff, right? This is just simple thing. If you want to go and calculate Greeks and you sell negative delta plus that becomes plus, and this you don't have to go deep into the calculations. If I have to explain delta in brief, then I have to put another 2 or 3 videos to explain delta or option Greeks itself. That alone is a big video, big concept. And standard deviation also. Simple thing. You always sell a 0.5 delta and on the both side. Then you have a probability of 70% of this trade going into profit, or 70% this trade expiring worthless. That's the concept, as simple as that. You don't have to worry about calculations or formulas or anything else. I'm just trying to make things simple, that's it. So that's it for today. I hope you like this video. Let me know your thoughts in the comment below. We'll do some we'll come up with some new concept, or we'll try to rectify our problems, or we'll try to correct things. I hope you enjoyed this video. Thanks for watching. Bye.